Hit it.
It's Friday, July 31st, 2026, episode 297. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, it's a no-guest show, and although we have our regular talking charts with Patrick, my co-host wants to turn the tables and ask me some questions. And maybe I should just get out in front with the following statement. No, it's not my burner account that continually litters the YouTube comments with the question. It says naked puts, but why is Patrick wearing clothes?
All right. Well, folks, listen, we're going to drink some beers because I'm going to need it listening to your commentaries here. So, Danny, what beer am I drinking here?
This is the Sierra Nevada Pale Ale. I used to drink a lot of this when I worked in a bar. It's fantastic. It's very strong. I think you're going to enjoy it. Would recommend. It's an American beer, I think.
Yeah. From North Carolina. It's strong. For a pale ale,
it's there in Nevada, and it's from North Carolina.
Yeah, it's
tons of sense.
All right, give us a disclaimer, buddy.
Okay, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the Magnificent 7 split personality disorder, the meta margin meltdown, and then the Apple expectation dysfunction. Something the older traders amongst us.
Absolutely. All right. Listen, Kev, let's just dive into this and chat about these markets. And obviously some volatility here. I'll accompany some of the charts to follow this along. But I feel the one thing that I want to start with is discussing the FOMC and Warsh and what happened here. Yeah. And essentially, the market came in with the least clarity in any meeting that arguably was there a Powell FOMC meeting where we ever went in with this kind of uncertainty?
There has never been since 1997 a meeting that had the expectation of a hike or a cut or a change to be this uncertain, meaning that it was going to move. And, I think Goldman Sachs had this great piece where they said, regardless of what happens, this will be the largest move in the front end of the curve, like the extreme front end, based upon the meeting, because there was so much uncertainty.
It was in the middle of it. It was guaranteed that the moment it happened that there was going to be a jump in either direction for
Correct.
Sure. And obviously you were writing about some of the influences that were going into that meeting. Where do you want to start? Do you want to start talking about how those traders were hedging the positions, which was certainly contributing to that uncertainty, or do you want to go into
let's just talk about the mechanics of what occurred going in. Okay. So usually in the past couple of decades, the Fed has been very clear about what they were going to do at a meeting. And there was, as we mentioned, there was never been a case where we had a situation where the market had priced in like a 40% chance of a hike. Right? It was usually 2, 3, 5% chance of a hike or something of that nature. And the reason for this is because Warsh keeps insisting, we've done hand holding the markets. Like that is it. We're no longer going to hold your hands. We're going to do the policy we see fit. And therefore you can't expect us to not surprise. Something to that effect. So one of the things that occurred is all of a sudden, if you're sitting there and you're a Wall Street bank or a hedge fund or somebody that is funding big trades, you're looking at the possibility that, he goes and raises rates on you. And now I used to work at a bank, and I can tell you that funding ended up being very, very important for the pricing of a lot of, of our trades in terms of the carry. And so if you're sitting there and you're a pod shop that has one of the most massive basis trades on, where they're long the underlying bond, short the future, they're all of a sudden faced with this enormous risk, right? That in the past, there was almost no chance that the Fed would hike in a surprise. Now, all of a sudden, there's a chance that they would hike. So what we saw was going into this meeting, there's a Fed funds futures contract that enables all participants, but mostly banks end up trading these things to hedge their Fed funds rate, meaning they can go in and they can actually lock in funding against the Fed funds. And that is, in essence, when you talk about, people talk about the CME, and they talk about, and they express there's a 38% chance of a Fed hike. That's based upon these Fed funds futures. And all for the past month, ever since the last FOMC meeting, when Warsh, indicated that that we were no longer going to hold the market's hand in terms of forward policy, there has been a massive seller in Fed funds futures for the August contract, just massive. And if you go into, if you were a stir trader, that's all the people we're talking about. It's just this person that just keeps wailing and wailing and wailing on it. And then if you're selling it, that in essence is causing you to think, that is locking in funding, meaning that you're hedging against the possibility that he raises rates. So that hedging actually created the environment where we had that 38% chance of a hike going into the meeting. And what was funny about this, Patrick, is that when you looked at the economists and the strategists, and I think I pulled up the Bloomberg economists, they surveyed 64 economists, only 4 had a hike forecast. So it was the vast majority of them expected rates to stay unchanged.
It was consensus, yeah.
Yeah, and so we had this strange environment where the market was pricing in a much higher chance of a hike than the economist or the supposed experts were. It was also interesting, Patrick, in that it varied in terms of the different market participants. If you spoke to an equity trader, I can assure you, chances are that their opinion was there is no way he is hiking. It was almost universal. I have talked to a lot of different equity traders. They were all very, very convinced that there was no way that he's hiking, right? But then you went and spoke to bond traders, and they were much more like, well, I think the market's about right, 40%. There is a decent chance that they hike. There's a non-zero chance that they hike. They were much more willing to actually contemplate this idea. So one of the things that I said is that we could have a situation where they go and they hike, and the stir guys go, yeah, we thought this could happen, but yet the stock market just shits the bed because there was no equity traders that were willing to go and bet that way. They were all completely convinced. And in fact, when he went, and it was the initial reaction of the unchanged policy, you actually look at the stock market, it was barely up. Like, you remember the initial reaction? It didn't, like the stock market guys were like, okay.
Well, they had it baked in. That was what they were expecting,
correct.
And that's what they got, right?
Correct.
Like, that's the normal reaction function on expectation.
And here's something I'd like to say to the stock traders is that go and spend some time and learn how to trade Fed fund futures, because you could have had this attitude that, oh, there's no way that he was going to go and raise rates. And you were like, I told you so. But the reality was, because all of your other, equity traders also thought the same thing, then there was very little benefit to being long. To me, that was like the wrong trade, to buy stocks because he wasn't going to raise rates. The correct trade was to go and buy Fed funds futures, because they instantly repriced based upon them not raising rates. So there was an easy arb there. So for those that, will say, oh, I told you.
I have it, a chart up here, Kev.
Yeah.
So this is the August 2000 and contract, and you can see the instant repricing up here.
Right. And listen, it's not that big a deal, but there was a lot of volume there. And that was a much better risk reward in terms of betting on him not raising rates. So let's now, though, go back and talk about what he's trying to accomplish and what happened during the meeting.
And what happened. I want to talk about that for sure.
Because, so we know going into the meeting that we had this situation where the market was the bond market was nervous, and the bond market was hedging by selling these Fed funds futures. And the reason that they were nervous was because they were funding a lot of the basis trades, and they realized that this was a real risk. The rest of the market, the equity market and other folks thought there's no way he's going to do it. But let's now talk about when the meeting occurs. Initially, the meeting happens, it starts, the curve steepens a little bit, meaning that the front end rallies, the long end is okay. And then he starts talking. And let's just rewind to the previous meeting. The previous meeting, he had said, okay, we are no longer going to tolerate the Fed not achieving their price target, not hitting the 2% inflation. And we are going to do things to fix it. And all of a sudden, though, we have this situation where we have this environment where the Fed is not achieving their price target. The employment situation is fine, yet they just paused again.
Yeah.
And as he started talking, and as more and more questions, got shot at him in terms of pointing out this discrepancy, the answers were just kind of more and more ridiculous. A lot of circular thinking, a lot of answering stuff with questions. And he lost the confidence of the bond market. He would have been better off just going, not cutting, saying the 3 cents, and then not having a press conference. He completely just screwed it up.
He should have done a Fauci and just take the fifth. Just stood there and just taking the fifth. I'm taking the fifth. I'm taking the fifth.
And so as he spoke, the bond market just got more and more nervous. And we can chat about whether he was trying to not answer anything, and whether his policy will work, and the circular kind of part of his thinking about him saying that he thinks that the market has gone ahead and tightened financial conditions because of his previous comment, but then he didn't realize that by not following through on that, they make a problem. But the long and short of it is the long end of the bond market voted with their feet. And that is the important part, right? That the long end said, hey, wait, you told us that this was a situation where you were going to take care of inflation, and yet we feel like you are doing anything but, and it's the same crap. And not only that, you seem like you're even more lost. And so they sold the long end hard. And I just want to remind folks, because I hear this all the time, Patrick, like they'll be like, oh, I'm going to buy bonds because the Fed is not going to is going to loosen monetary policy, or is not going to tighten. And here's a situation where him not tightening actually caused rates to rise. And the reason it caused rates to rise is because the market became more uncertain that he was actually serious about inflation. And this is why I continually and just hammer this home, that folks think that, the Fed cutting rates means bonds go up, and folks think that Fed raising rates means bonds go down. It's not that simple, and the curve can really change, and it depends on where the Fed is and how it's behaving. And this was a perfect example where him not raising rates caused the long end of the bond market to go no bid and for rates to rise.
So I have here the 30-year yield on an hourly chart basis, and I circled in this little red circle the 3 o'clock candle, which is the 2 o'clock candle, which was the one that had the actual release.
Yeah, so that was that was the announcement.
The announcement, but it was when Warsh was speaking that huge jump happened. Now I'm going to put this on a daily chart and just put the significance that we cleared a very important May high, which is technically unless you think this is a prairie dog, this is a bad news, buddy. And
I'm with you.
But the one thing is that it's not just the one high, but we have to go back to 2023. And back in October 2023 was where that high was originally thing. And this one wise guy I have that I do a show with says there's no such thing as a triple top.
Yep.
And I don't
No
know who
such thing.
said that.
I should have known that this was going to happen because there's no such thing as a triple top.
Yeah, some wise
guy. Known.
Yeah. And so in the end, this breakout is pretty explicitly clear on that, and the long bonds taking it. But I think and so first of all, your analysis is spot on. Like, I think that I have nothing to really say differently on all of that, but I want to highlight, like, so the long bond makes this move. Clearly, the Treasury and the administration are not ignoring this. This is like when we had this spike back in when we had that last spike over here in middle of May on the yield. Immediately the administration responded with talking back the markets. And even this little spike back over here on the July 23rd was met with a headline that there's some sort of talks and maybe there's room for things. They put in some sort of a news announcement to just calm the markets down. Now that we've cleared this hurdle, we have a situation where oil is back to 85, 86 bucks, trying to turn back up. Yeah. And these bond yields are ripping, which is the two things I think that the administration is paying very, very close attention to. And Warsh kind of made it more
challenging
for them to manage this. And so what's your kind of...
so the real question is, did Warsh make a mistake did he know what he was doing? Or, did he make a mistake in he really is very hawkish, and he just made a mistake in that he didn't understand how quickly the the bond market would want him to follow through with his actions. Like, that could be it. That would be one of the things. Part of the reason, by the way, the market was at 38%. I was slightly higher. I was at 50-50. And the reason, in terms of the actual hike, and the reason I was more 50-50 was I was thinking it through from a game theory perspective. And I was kind of going through the logic of, if we have a situation where they pass in July, and then inflation gets worse, that means that they will be even more forced to go in September. And given that it's so close to the midterms, from a political point of view, it made it more awkward. And so
thank you. I literally, my argument to my members was that, look, the market's already pricing in like 1.5 cuts this year, this year. And it would make more sense for a Warsh to just get the hike in and then have far less pressure during the political cycle to not get political, just basically stay out of it and think. But now we have a market that is pricing a 67% odds of a September hike. And obviously October is just pricing in a small chance, like 20% that chance that we have a second hike in this cycle. But the interesting part, Kev, was that in the December numbers, the belly of the distribution is now favored only one rate hike. We're at 40% for one rate hike and about 37% for two, which is okay. Let's call it a split. But that lightened up after they didn't act on this meeting.
Okay, so now one of the things that you need to remember is that if we're talking about what the Fed will do, not what they should do, and I'm of the belief that even though I expect them, or I had expected them to hike, or at least I expected them more than the market expected them to hike. I suspect that will be a policy error, that the economy actually can't take that. And so one of the things that I am sympathetic to the idea that if I was on the Fed, I might look through it and I might be like, no, it's okay. The market's going to come around. And really, the mistake almost might be Warsh saying that they were, being so adamant the previous meeting, saying he was going to get back to 2%. And he said it again, Patrick, by the way. He highlighted and hammered home the fact that they're going to get to 2%. I saw, for example, that Jeff Gundlach had misread the previous meeting. And I remember kind of highlighting the fact that he heard what, I don't know what he heard, but he interpreted the previous meeting as that Warsh would allow 2.9%. And that's not what he said last time. And this time he made it absolutely clear that he's going to get to 2%. But you can't say you're going to get to 2% and then not do anything about it. And this ultimately is the problem. And I go back to, did he make a mistake by being so hawkish and by kind of tricking the bond market into thinking he was going to do something today?
That's a credibility issue, right?
Right. And this is the issue. Like, he might have made it all the worse by saying one thing and then not following through. It's people are like, what the hell is this guy thinking? Like, he doesn't understand what's going on. Or is he trying to talk hawkish so that the bond market does the financial tightening that he doesn't want to do? And that's the other argument, right? Like, the folks will say, and all you have to do is look at his actual FOMC press conference, where one of the reporters asked him about this, and he said, no, actually, look, the market has tightened monetary conditions, and that has worked. But what he's failing to realize is that by saying that and by pointing out this thing and then not going and doing it, he's making everyone become much more nervous, which brings me back to the point is, I think he would have been better off just having the meeting and having no press conference, because he's trying to have it both ways and trying to do all this stick handling, and he's just looking like a fool. And in doing so, he's making the bond market very nervous. And one of the things that I'm very concerned about, Patrick, is that we have to remember there was a period when bonds almost led stocks down. Like, we had that period during the tariff problems where, we had stocks going down, bonds going down, and the US dollar going down. And let's just talk about the last few days. We're back on that, right? US dollar going down. Now, that's because of the yen, but we'll talk about that later. As the stocks are going down, or were, and now all of a sudden bonds are going down. And I'm very concerned that he's playing with fire, and that by this credibility issue, he's risking the long end going no bid. And back to the September meeting, if we get a situation where the inflation gets worse and yet we have employment staying firm, and then they don't raise rates, I think the bond market could absolutely have a conniption. And then all of a sudden you're forced to raise rates, right? Like, this is just bad. And so I really believe that this was a mistake, and that he would have been better off at the very least just keeping his mouth shut. And it's a more dangerous situation than the administration the Fed would probably realize.
How long until Trump wants to fire him?
Yeah, I don't know. And the other thing about everyone tells me, they say there's no way that, like, they'll argue that Warsh is Trump's puppet. And I understand that argument. And again, if you believe those things, then go out and trade Fed funds futures, because the next time we get a situation where there's market pricing in a rate hike, you can make all sorts of money if you continue to be correct that he's never going to raise rates. I don't believe that. I think that he will raise rates, and it'll be a mistake, and that he's made it so that the pressure it'll be a panic raise, which will
Yeah.
be way worse than a raise where you're getting out ahead of it. And ultimately that panic raise will be a policy error, which will then ultimately mean lower rates as the economy slips into, a recession. And so it'll be a point where you can buy the long end, but in the meantime,
Okay.
he's playing with fire. But
So
one of the things is I don't buy that this idea that Warsh is Trump's puppet.
yeah.
Warsh is there for 7 years. Trump is there for 2. Let's hope 2 more years. And the reality is that I think Warsh is thinking past the Trump administration, thinking he doesn't want to tarnish his legacy.
So what I wanted to ask you about is obviously the case you have is one that I generally have spoken about to my members as well, is the idea that this is a one and done kind of rate hike, whatever's coming.
Yeah.
And what is interesting is the SOFR futures align with that. Why? Well, the December 2026 SOFR is trading at 95.92, and the December 2027 is at 95.86, literally 5 basis points different.
Yeah.
The point being is that right now, stir traders are not pricing in any move next year. Like that, like literally, they're just debating at this moment whether or not there's 1 or 2 rate hikes this year. And as of this moment, there's either a complete lack of commitment or clarity as to what direction rates will go next year, or they literally believe that that's just the right price. I think that the market just doesn't. I don't think they just know which direction is going to go next year, and I think that at this moment there's a lack of clarity or commitment to actually pricing 2027.
Yeah. And well, the other problem is because the Fed's all over the map, with all these different things. And let's just talk about the fact that he's made 5 committees for it. For a guy that hates bureaucracy, he sure has been pretty quick to make committees. The market is confused. And the other thing is that, Patrick, if you make the market more confused, you have more volatility. And if you have more volatility, that means that the risk premium should go up, and it means that financial assets should be lower in prices.
So the one thing I'll ask you from a trade perspective, I'm of the opinion that while obviously there is more immediate risk on the long bonds, and being in the long bonds has clear risk. We broke to lower lows, things are but with the fact that they're already pricing in 1.5 rate hikes this year, do you believe that generally this is the bottom end of the kind of SOFR and 2-year market, 2-year treasuries, like that this is basically pricing in the top end of the interest rate cycle, and that we're not really going to go much higher, and that there's some degree of asymmetry in being along the short end?
Yes, 100%. I think that's what the market's telling you as well.
The market's telling you that, but I'm just asking of you.
Yeah. No, I agree with that. Like, for example, I own December puts, but on SOFR. I've had this for a while because I think I wrote about this way back when, in terms of that they were going to have to get more hawkish, and I believe I put this position on then. But it's a 1x2 that I did, meaning that I bought like 1 put and then sold 2 out of the monies. And the reason I sold 2 out of the monies is that I don't think that they're going to raise, like they're not going on a campaign where they raise 3 times. And this is the other thing, Patrick, I hear from a lot of folks, this notion that the Fed never raises rates 1 time, right? And that is a very common notion, right? That they go, when they start raising rates.
That's not true.
Listen, I can't remember all of it, but I contend that there have been so many things that have never happened before that are happening now, that you should be very careful about using old playbooks. In general, when the Fed raises rates, they raise rates at least 2 times, 3 times. And so that's why you'll see a situation where, like, the Bank of America at one point, I think, had 3 rate hikes, as their forecast. They were talking about September, October, December as hikes, right?
Right.
Or maybe, but anyways, the point being, I'd be very careful. I think the Fed could raise rates once, and things roll over really quickly, and then they're cutting rates
So
shockingly quick.
where's the flaw in my thinking? I'm in the camp where it's very likely to be policy error because we've had this conversation on the show before. But to me, inflation is very much supply shock driven from war. The war has created obviously logistical problems in moving oil, shortages in fertilizers, all these different things generally causing prices to rise. And that is one of the kind of precipitating drivers that is pushing inflation to levels where the Fed is uncomfortable.
Yeah.
But the mechanism from which the Fed is the only tool they have is a monetary tool, and they can't solve shocks. So the thing is that when the entire global economy is suffering a huge tax on the war, which is slowing the economy, they're trying to fight the higher price by slowing the economy by actually things. So there's two inputs slowing the economy. If that is inputted with a third input, which is the AI bubble bursts, and we have an equity drawdown, then the question is there now an increasing risk that the triple whammy would basically cause a recession, and that this is actually going to be where they simply are going to now see economic numbers that they simply can't justify higher rates.
I'm 100% in that camp, Patrick. I think we're way closer to recession than anyone believes. All you have to do is look at the Bank of America fund management survey. You'll see that 2% of participants are calling for a recession, in essence, what they call a hard landing. Contrast that to 2023 when everyone was convinced that we were going to have a hard landing and we didn't. And I'm very much believe your three reasons you outlined are correct. But let's stop and think about let's invert it. Let's imagine that's our base case, but let's do like the Charlie Munger. Let's invert it. How would we be wrong? Like, what would it take for us to be wrong? And when I'm thinking it through, this is the kind of the argument where you could get a situation where rates are much higher. Let's imagine, first of all, that the AI bubble continues. It doesn't pop. The reality is that this is just a slight hiccup along the way, like SVB, Silicon Valley Bank, and we've already had the flush, and now we're going to go back to spending.
Leopold's been washed out.
Now we're going to head higher. So we're going to go back to doing that, and we have this situation where, although we are sitting there and it seems like rates are low, if you stop and think about rates in like the grand scheme of things over time, they're not as low as they might seem. Not only that, those rates haven't been so far enough to stop that expansion. And if we get private expansion of the money supply as we continue to spend and borrow to fund this AI trade and to do different things, and let's just imagine some other things start kicking in terms of tax breaks or something like that. Maybe there's some sort of fiscal cut as they try to win the midterms or whatever. The reality is that if we get a situation where the economy starts to take off, we could be back in a situation where maybe rates are going to 8%. Like it's happened before. And so we're sitting there 100%, not 100%, but we're confident that the economy is weak and is about to roll over. Yet the economy has been remarkably resilient. Maybe this was a pause, and maybe we're about to take off. And not only that, Patrick, one of the really worrisome things is if the Fed is showing signs that they are not going to tamp down on inflation, that encourages people to borrow more and to go out and try to, like take advantage of the fact that real rates are low, even though
So
I know on
credit,
points, yeah.
well, the credit expansion has not been hot. And this is not a thing that needs to be cooled. But
But Patrick, it is. If you look at banks, it actually has been. There's a shocking amount of private sector credit expansion out there, and that's part of the reason
in the hyperscalers world.
Yeah, but even just in the bank's loan book has been going up, and that's part of the reason the economy has stayed stronger than we expected.
So now, okay, so now there's like whatever, like $100 trillion of debt that's in the U.S. system. The interest on this is like $7 trillion a year gross. This is all the entire credit stock, not U.S. Government debt. This is like, we're talking about the total debt. The question is, this fantasy that rates have been higher before, so we could go back there again. I would argue that that the economy would never be able to endure the same type of rates when the debt per capita was at a much smaller debt per GDP capita, whatever ratio you want to use.
The deficit has never been this high, Patrick.
Yeah.
So they're
on all fronts,
creating more money. And then not only that, we haven't, quote unquote, had as much transformational technology and just encourages people to do it. The reality is that if you claim the proper level of interest rates, I think you need to be careful, because one of the things that all you can really be sure of is that as you raise rates, it increases the chance that this happens. But we don't really know if we're too tight or too loose. And you might argue that this bubble that we've created over the last year or two has been a condition of the Fed being too loose. We might be dramatically more loose. Listen, I don't agree with this, Patrick. I'm just taking the other side, and I'm just talking about the risk. I'm with you. I think the economy is actually way weaker than it seems. I believe that this is a solely an AI bubble that is driven, and it's been kind of almost rates don't seem to matter at all. So we have this situation where if we raise rates, we might, like, it didn't really change the AI trade at all. And so I'm with you. I think that we're going to get a situation where the economy rolls over, but there is a case to be made that we don't know the right rate of interest rates, and that there is a side that maybe it just takes off.
Oh, we're about to find out. That's why we have stop losses.
Yeah, and that's why we do stuff. That's why we do stuff in
right.
using options. Okay, so
all right.
Let's
so there's a lot of things we have to cover.
Okay.
We'll circle back to the yen, because I think that this is a very good segue for us to talk what's happening in the stock market, particularly in the tech space, and obviously we saw an extraordinary hammering on the momentum AI bubble space. Well, I call it a bubble. Some people don't, but in the end, in the AI momentum trade,
Yeah.
And I think I saw a stat out there saying that this was like one of the largest 1 month drawdowns momentum hedge funds have had in like a decade. And it was pretty much a bloodbath out there, taking down, obviously, like Leopold's situational awareness fund, which was, first of all, do you want to talk about that?
Patrick, there's so much to talk about here. Let's just start with the idea, and let's try to remember what we felt a month ago. Yes. A month ago, these AI trade felt like it would never end, right? Like it was just, I was getting flack for being bearish AI. I was told I didn't have a clue what I was talking about. I didn't understand how transformational the technology was. We had things just ripping higher and higher. And in the case of like 3 or 4 weeks, Patrick, all of those gains have just been absolutely destroyed.
Absolutely. Let's start with a chart on the Kospi, because this is the epicenter where it did the Eiffel Tower,
It
right?
really
Like,
did. And I just want to remind folks because, I've talked about this in the past about these series of rolling mini bubbles.
yeah.
And I found my original post, Patrick. It was 2014.
Oh my
That's when I
God.
wrote it. That was
You,
when
you back when you had hair.
yeah, exactly. This is how long ago, Patrick, it was. At the time, I said, you know what? There might be a bubble in a stock. Sorry, there might be a bubble coming up here. And if you wanted to take a shot on something that could get bubbly, you should buy this stock. Guess what stock it was?
Tell me.
Tesla. That's
Okay.
how long ago it was. It was $5 at the time or $10, and that was pre-split. And anyways, I talked about these rolling mini bubbles. And they're not so many anymore. They're becoming bigger and bubblier. And I just want to just remind folks, though, because a month ago, you felt like a complete heel if you weren't long these things. And, everyone was making fun of anyone who would suggest that these were dangerous stocks that you should be worried about. And now we have the largest momentum correction in history. The momentum volatility, I
Is it
believe,
in history
I think it is. I think it is. And the momentum
for 1 month or?
yeah, the momentum volatility factor had the highest realized vol over 1 month apart from recessions that we've ever seen. Right.
Apart
And
from
apart from recessions. So basically the last time we had this much volatility in the momentum factor was the GFC and 2020. Apart from that, we've never had this
You
sort
mean
of volatility.
2000 or
No,
2020?
I don't think they went back
COVID?
that far for the momentum
So
thing or
COVID?
what. Yeah, it was COVID and it was GFC. And so I just want to remind folks because it's easy to say now, it's so obvious, but in reality is that at the time, if you were preaching caution, you were labeled a bum who didn't understand how transformational the technology is. And what's that risk happens fast? Like it really does. And whether it be the Kospi, whether it be momentum factor, whether it be Micron or whatever, or the DRAM, these things have gotten absolutely destroyed. So what's the Kospi down? It's down 44%, I believe, at the lows.
Before today's reversal.
Yeah.
Overnight
and
reversal.
now it's, everyone's talking about what a ripper it is. And I'm looking at this chart and going, okay, great. We've ripped higher, but let's just remind ourselves the largest and sharpest and most vicious rallies occur within bear markets.
It's a deceptive thing to look at percentages because percentages on the way up versus percentages on the way down are disproportional because of the convexity of it.
Yeah.
But the thing to highlight is when you think 17% up day, like what we saw, almost 18% up day, you would imagine, well, that's almost half of the 40% drop that happened on the way down.
Right. But
so in theory, it should be somewhere halfway up this chart. And it's not. It's back to where it was last week. No, actually, not last week. It was back to where it was Monday. Not
Great
even.
point.
It's not even above Monday's price.
Yeah. So you guys can get all excited about it, but the reality is that
handle.
This thing has been a disaster, and it's been a huge money loser.
Back.
Yeah, and I contend if you look at silver, it very much I think that the semiconductors and the memory stocks are going to behave like silver. And let's pull up a chart of silver, Patrick. Let's go look at it. I again remember, on the way up, feeling like a complete fool because I was like, I'm selling my silver. I don't know what's going on here and stuff. And then it declined, had the huge, correction, rallied back up a lot, and now it's just drifted lower. And that's what I think we're going to see in these semiconductors and these memory stocks. It's going to be the same chart. It's going to just be a drifting lower. And I continually tell people,
we don't know for sure.
No, we don't.
On balance of probabilities, this is what typically happens after a bubble bursts. But what I want to highlight with silver and use the analog. In fact, I actually think for the Kospi, the better analog is actually the Nasdaq back in 2000. For particularly for this case. So I'm going to put on a weekly chart. I'm just going to go back to 2000. And what I want to show is that like what happened, there was an extraordinary rip on the upside of the NASDAQ. In that case, it was, this 400% rip on the upside over the 2 years prior. There was off of the top, a peak to trough drop of 40%.
Yeah.
Kospi was down 44%. Then in the next 3 months, the NASDAQ proceeded to do a 43% rally, which was nowhere near its previous high.
Right. And that's back to your thing about the math. Like, think about that. You lost 43%, but then you made 43%, but it doesn't mean you're back to the highs. It means you're halfway to the highs.
Yeah, halfway to the highs.
Yeah.
And then it rolled over and died.
Yeah.
And so to me,
and by the way, folks,
this is a cleaner analog than silver for me.
Okay, fine. That's fine. They're still kind of in the same ballpark.
And the same ballpark.
Yeah. And folks, just for the back to the 2000s, I saw recently a very famous, strategist / former hedge fund managers, newsletter writers talk about how you should close your eyes and buy everything, because the reality is that tech goes up forever, and all those things were, buying opportunities throughout the years. And he even mentioned 2000 was a buying opportunity. And I just want to remind folks that if you'd bought in 2000, you weren't even on a nominal basis till like 2015. Yeah, right. It took
years before you break even.
Broke even. That was not even in
and that's assuming you didn't own individual stocks that like 90% of them never it got wiped. So you had to be in the index.
So this idea that you can just buy these things with no thoughts about the valuation is why we've had this bubble, right? Okay. Like this is the problem, is that lots of people have just been talking about this and saying valuation doesn't matter. Okay. Nothing matters more than valuation. Maybe over the short run, it doesn't matter because valuation can get more and more expensive. Over the long run, valuation means everything.
Okay, so let's briefly just give some lip service to Leopold Aschenbrenner and his situational awareness fund.
He wasn't so aware, was he, of the situation?
The irony of the name of his fund, right?
Yeah.
Because he was situationally aware of AI, but not situationally aware of how stock markets work.
Yeah.
But it's a very, very, very big difference. And the fact that, I'm sure when he was at OpenAI and everything, that he used AI to help him write as a 24-year-old his amazing thesis, which then convinced investors that a 24-year-old is the right person to run a 4x fund, like 4 times leveraged fund,
on one of the most volatile sectors in the world. Like it wasn't 4 times leverage on utilities.
It makes Michael Saylor look like an angel. Like it's like, you know what? It's unbelievable the fact that Michael Saylor outlasted Leopold is unbelievable to me.
But the part is the really funny part is, Patrick, is that anybody is surprised that this happened.
What? A 4x leverage. Think about that. 4x leverage means that when he at one point when he had $40 billion in the fund, he was pressing $160 billion of equity, which basically you couldn't use traditional margin to do it. So he clearly was using some sort of
Oh yeah, he's using
secondary
ISDA and swaps and stuff like they're
swaps
for
and
sure.
other types of things to
Yeah.
reach, because you ain't doing it with traditional margin.
Yeah, no,
But
he's not.
but the thing is that when you play in the with ISDA accounts with the big boys, everybody at the firm you're trading against knows your position.
Well, not everyone, but too many know your position.
Too many
Yeah.
position,
Yeah.
and it's you put yourself as a target.
Yeah.
Or a mark.
Patrick, he got Amaranth. And Amaranth was, for those who don't know, was a hedge fund that traded lots of different things. And it actually was just one trader that got them in all this trouble. And it was a trader that was huge in natural gas. And he put on this very liquid, 3-year out spread. And I can't remember what it was, the Widowmaker, the April versus, or was it like March versus June spread or something on the nat gas. And he just got way too big. And then the other traders on the other side realized that they could stop him out. And that was what happened. And it was the liquid position. And one of the smarter traders from Enron that had gone on to trade his own fund. And with I think it was Morgan Stanley. No, it was JP Morgan. But the prime broker ended up taking part of the position on because it started to go against them. And I just remember back, Patrick, to the one of the greatest books of all time was like When Genius Failed. And it was about long-term capital. And at one point they're struggling to, stay alive. They're busy trying to find money to shore up their balance sheet as all their positions are going against them. And John Merriweather, who's the head of long-term capital, he calls in this buddy of his, this Italian guy, and he's old school New York Italian dude. And they describe him as coming in with a silk shirt that's open, and he's just old school trader kind of dude, right? And he comes in and he, John says, I want you to have a look at our books and tell us what we can do. And the longest story short of it, Patrick, is that the guy says, okay, well, how much are you down? And John says, we're down 50%. And he says, you're done. And he goes, no. Well, you look at these, look at this, look at this. He goes, it doesn't matter. Once they realize that they can take you down 50%, they realize they can take you down the whole way. And that is what's happening. Wall Street is like they eat their young. And
and the fact is that they don't there's always the picking off retail investorship, but that's small time. They look for the where a shark can take down another shark.
Or take down a whale. Think back to when Bill Ackman was dumb enough to talk about Herbalife and how he was short so much stock. Well, Carl Icahn and Loeb and said, okay, well, if he's dumb enough to be short that, let's go squeeze him. And they squeezed him and he got absolutely nailed. And so the reality is that when people put on too big a position and then it starts to go against them, they're sharks and they smell blood in the water. And that's exactly what happened here. One of the things that I people say, I can't believe it bounced so much once it cleaned up. And the reality is that it's kind of the opposite. You need to realize that most big guys would have known that portfolio was for sale. And at the very least, if they didn't know the portfolio was for sale, the prime brokers were busy selling off positions, trying to shore up the portfolio as it went down. So there is no doubt in my mind that part of the AI correction that we've experienced over the last week or two has been him getting stopped out. It's not just all of a sudden.
I think he was the marginal in a live auction in the market, the marginal seller is the one that drives the price.
Well, he was the final bit. He was the final bit, but the whole, it wouldn't have happened all at once. It wasn't like they didn't try to sell stuff. They weren't, as it went against them, they would have been selling down positions. They would have been in trouble. But what I suspect happened was they started to go down so fast that they couldn't get ahead of it. And I can tell you, I've understood that. I remember during long-term capital, Patrick, we had a situation where I was short gamma and I wasn't monstrous, but I remember it was illiquid afternoon. And all of a sudden, one of the New York banks that I dealt with, they also had a Toronto book or a Canadian book. And they phoned me up and they asked me for bids on stuff. And it was just super illiquid. And so I bid down and all of a sudden they hit me. And by the time I went and tried to sell their position that I bought from them, I only was able to sell half of it. And then not only that, I was getting longer as well. So we had this situation where the more we pushed it, the more it went against us, and then the worse it all
feedback
got.
mechanism.
Yeah, and I think that that's what we got. And let's remember. And I wrote this piece about this, Patrick. The 2 and 3 times leverage ETFs have never been larger, right? And so on the way up, that feels great because everyone's buying more. And for those who don't know, the leverage ETFs at the end of each day, if it's up, they need to buy more, and if it's down, they need to sell more. And so on the way up, it felt great. It was just more and more and more and more. And it just encouraged people to get longer and longer and longer. And then on the way down, it's the opposite effect. And that is what's occurred. So we had this perfect storm.
I have a great story that someone that I know, I'm not going to reference names, told me his mother opened a self-directed brokerage account. And she absolutely loved her favorite position, which was SOCL, which is the 3x leverage, because she's making so much money on this thing. And literally, when he told me, it was like $250.
Yeah,
I'm like, when I hear someone's mother is into the 3x leverage semiconductor, and not understanding what she owns, like the thing went from 300 down to 100 in a month.
Yeah, I can tell you, Patrick, I had sold call spreads on the way up on that one, because I thought, oh, it's okay. I'm gonna it'll go up and down and it'll chew, and I just didn't expect. I think I sold like 150, 175s or something. So on the way up, on the initial way up, and so I sold them. And the next thing I know, I'm looking at these things and I'm like, these are like $100 in the money, right? And I'm like, oh God, right? I just like another stupid trade that I did. I thought to myself, and Patrick, I couldn't believe it. Thank God I didn't like take them off for pennies. They all expired worthless. It was shocking how quickly they went down. I was flabbergasted. And I don't think people, to your point, understand the real risk in there. And then also the fact that they're going to get chewed up with the volatility. Anyways, going back to this situation that we have right now, there's no doubt Leo got stopped out. Some people are saying, oh, this bounce is too much. To me, it's more that the selling stopped. And that was the important part, right? So we got this situation where the selling stopped. And now I think it'll be very difficult for us to get these stocks up and going. Nobody's going to be extending out 3 and 4 times leverage on these things anymore. That your buddy's mother is probably not going to be buying more at the top. She's not going to be doubling down on this trade. It's going to be tough for this thing to do well going forward.
So here's the interesting part, right? Like, look at the magnitude of the velocity on the way up, but also like this thing got clipped basically 70% on the downside, but it cleared below its June low. It cleared below its May low and literally traded almost to the same price it was trading back in February and March. When you compare that to the SMH just barely had 1 day close below the May low. The point is the magnitude of that decline, whatever way that the SOCL clears, there was some sort of daily close repositioning shit that was going on that created slippage here that made the velocity to the downside even exacerbated that much more.
Yeah, because they were buying more at the top, like they were buying more as it goes up. And listen, for folks that are interested, send me an email, kevin@themacrotourist.com. I will send you my piece that goes through the math on the levered ETFs, that walks you through it and shows you why these things are so dangerous.
So my email is pserezna at no.
You already got it, you bugger. You got to actually spend some time to read it. That's your problem. Okay, what else are we going to talk about here?
Okay, well, look, the S&P 500 was interesting. I was reading the Goldman Sachs CTA thing. They were talking about on the SPX that the 7450, 7400 area down here was that first layer of CTA triggers. on the short-term ones, and we just turtle-headed the CTA trigger, uh, and came back above. Clearly, CTAs have been kind of the CTA selling is not there yet, but the interesting part is that they're now a player on the field. Like they've got to now essentially keep the S&P relatively elevated in order to prevent that new marginal seller from being a player on the field.
You know what? Can we just? What's amazing about this market, Patrick, is that the leaders just got clipped. Like we talked about Leo getting stopped out. We talk about Micron and the semiconductors getting absolutely nailed. And the S&P is what, 3% from the highs?
Yeah.
And that is truly and utterly fantastically astounding. Really, like it really truly is.
You know why? Because we talked about it on the previous shows. Is like we asked, is it going to be a sector rotation? And
right, and it was, but you would still think
that.
by the major part of the most important sector getting hammered so hard
that it would spilled into a liquidity thing, but it didn't. Yeah. And so notice here, this is the breadth of the market by the number of stocks trending. We got up to 72%, 73% just a few days ago to a fresh high, higher than we've been at any point since January. And so the point here is that that money got sprinkled everywhere else, and more importantly, the Mag 7s. Let's go through the Mag 7s. The disappointing story had to have been Google, but look at the way Google got bought on dip. Generally, it gapped down, but it's been saving the day. And obviously Tesla has had a rough time and is taking it pretty badly. But like you take a look at Meta, which took it badly, still holding a previous low. And of course Apple just came out and gapped down and disappointed back below its 50-day. But Apple was actually driving huge flows. Like there was taking a lot of, like people were selling semis and going into Apple. This was a rotation. Now that Microsoft joined the party after the interesting turnaround in software in general, because by the way, it was interesting. One of the things, do you know any more detail on? But I heard that Leopold actually had a short position in Adobe. And a few other software names
well, I can tell you they were trading almost tick for tick the other way. So that makes complete and utter sense, right? The correlation between like semis and memory to software was shocking. The negative correlation was shocking. So that doesn't surprise me.
So that long short pairing clearly was a structural unwind.
Yeah,
that was literally happening under the surface. But Microsoft turned. It'll be interesting to see because, we've talked numerous times about the importance of the Mag 7. Now, the Mag 7s on their earnings valuations, you can make the argument that they're cheap. I've heard this so many times, but you can argue with me in terms of the quality of that earnings and things like this. But the valuations are not bubble-like in the Mag 7s. But the path of the Mag 7s is incredibly important, because 1/3 of the index is in these 7 stocks. And if they're not selling when memory stocks and the SOX index is going down, then if the rest, it's not enough to create an imbalance on the overall index. And that's what happened.
Yeah. S&P, but also back to your breadth thing though, Patrick, is that it's not just that. Like, I thought for a second, isn't RSP at new highs?
Well, yeah. So you're talking about the equal weight. So the equal weight, let me just pull it up here. This is the equal weight index. Yeah, fresh high back on Wednesday.
Yeah, and this is what I've also argued is that we couldn't get selling in those the things that everyone's long, and we'd be surprised at how much the other ones go up because they're so small compared to what everyone's long. But Patrick, I think we're getting close to the end of this. That the whole market's going to roll over soon.
So, you know what's an interesting? I have a speculation. I want to put one out there. Um, basically, Steve Eisman was on CNBC. Did you see that interview?
No, I missed that one. What did he have to
Okay,
say?
so he talked about the fact that he sold some of his Google, and that you thought the market's rolling over. Uh, and when they kind of pressed him on the issue of, well, what are you buying some consumer staples and some, like I think, and he's like, what am I going to do? Buy a Clorox? That shit never goes up. Like he goes, I'm going to go to cash. But what's interesting is I looked at it and thought, like, that's actually the broad consensus in terms of the fact that the consumer staple names have been so washed out.
Yeah.
They've been going down so long that everyone thinks they're a value trap. And they say it is stupid to own them. Why would anyone throw any money in there? You're better off in cash on a T-bill. And I'm curious whether this actually marks the capitulation low in that kind of value versus momentum factor.
So what you're saying that Steve Eisman shitting all over the staples will be the
I don't know if I want to call him out. He just brought it to my
he just brought what is consensus. I completely agree with you. I'm just listen,
Like-
he's a big boy. I'm sure he would laugh if you told him that.
Yeah.
The reality is you're right, Patrick. Whenever you hear someone and whenever something is just consensus and can never happen, you have to ask yourself, hey, wait, is that going to be the surprise? And that's just the way the market works.
It's because it's interesting because like I'm just going to go through very quickly a couple of names, but like this is like the chart of death of General Mills, right? Going from $90 down to 30, right? Even look how much trouble Warren Buffett had over the last 2 years, where basically Berkshire has basically been flat.
Yeah.
Like literally inactive. Like
even
why
with all
would you
this
give
Apple.
your money to why would you give money to the Oracle of Omaha?
What does that old man know about investing anyways?
Absolutely. Now you give it to Leopold. He's the next Warren, right? Like he's the next prodigy.
Yeah.
But like the point being here is that there's a ridiculous amount of these beaten down Clorox, Whirlpool, like whatever. These things have been charts of death, and these things are being destroyed. And the fact is no one wants to touch them because they believe it's a trap. I'm just curious whether they have their day in the sun. I'm just asking, like, I'm not making a bold call, but I think that there's enough people that have given up on owning them that when performance starts to appear there, people chase performance.
Yeah, I won't disagree. There we go. There's the big call. Staples are going to go, according to Patrick.
I think so. Let's talk currency. I'm going to pivot here because we got to talk yen because we're going to run out of time.
Okay.
So I'm flipping the chart here. This is the yen US dollar, not the US dollar yen, just so that we can really be clear. We're talking the yen chart here. But so we had rumor of intervention, and then we had the BOJ statement, kept rates unchanged. What happened?
Wasn't a rumor. They confirmed that they were intervening.
Okay.
I think they intervened the most they've ever intervened. Right.
Okay,
and so that's the reality is that the Bank of Japan came in there and they hammered it as hard as they've ever hammered it in. So now the question becomes, is this just another chance to sell into? Because every, previous intervention hasn't mattered in terms of over the long run. It was only 2-3 days ago that the yen was at all-time lows, or not all-time lows, but lows for this current move. And so the question is this just an opportunity to sell more, or is something changed? And
it would become a fourth factor on the downside if we had the carry trade unwind thrown into the fray of a tech bubble thing and all the other stuff we talked about in headwind Like,
Well, don't laugh and say that. I strongly believe that that is a big, huge potential. And not only that, Patrick, I wrote a piece about this. I think that ultimately intervention only works so far. And the reality is that intervening to get your currency down is actually pretty easy because you have the ability to produce unlimited amounts of your currency. Intervening to get your currency up is much more difficult because eventually you're going to run out of the other currencies to sell, and you can only do so much of that. One of the things that ultimately needs to be done for Japan to fix the problem of their currency going down is they need to change the investment makeup of their citizens. And if we think about the Japanese situation, they are the largest savers of capital in the world. And increasingly, a lot of that capital is saved overseas in different things. And the largest pension plan in the world is the Japanese postal GPIF. And if you look at their portfolio makeup, it's 25% foreign bonds, 25% foreign stocks, 25% local stocks, and 25% local bonds. And through a time that has changed, and it had increased. As if we recall, it's kind of quaint to think about now, but it wasn't that long ago, Patrick, that the yen was suffering from being much too strong. And Abenomics was trying to get the value of the yen down, right? It was 90 or 85 or whatever it was, and they were trying to get it down, meaning higher in terms of USD GPY. And
this was Abenomics back over here,
right? And one of the things they did during that period was that they changed the makeup of their of what they GPIF would hold. They used to be, I can't remember, 75% local domestic stuff, and so it's been an absolutely terrific trade. And when I think about what it's going to take for them to fix their problems in terms of the currency, it's very clear to me that changing the policy makeup of the GPIF and other pension funds is an important tool. And I've just been waiting for them to do what is kind of inevitable in terms of them changing that policy. And they finally, about a couple of weeks ago, had a situation where they threw, the shot across the bow, and the finance minister mentioned that this was coming. And so one of the things that I strongly believe will happen is that we're going to have this situation where this changes. And, up until then, the interventions are nice if you're long yen. But once that actual policy change occurs in the GPIF, that is going to mean that the US JPY is going to be on offer forever, meaning that the yen will be bid for years and years and years to come.
So using this as a segue to obviously, we saw this jump in the yen, which was only returning it back to the levels where it was back in May. So it's a big deal for a one-day move, but it still has a lot of work to reclaim anything that it did this year. But what's interesting is how everyone's positioned on this. I want to go to the Commitment of Traders report here on the yen futures positioning here at caughtsignal.com. What I wanted to show you, Kev, here is that positioning right now on the large specs is at the 1 percentile. And basically, we can call it the 0 percentile of 1 year look back. And when you look at their as a percentage of open interest, we're pretty much right along 5-year lows in terms of their positioning. But when you break it down to actually gross positioning, look at the amount of net short contracts, 260,000. If you do a look back over the last 5 years, there's no point where large specs have been net short this much of the yen.
Wow. I didn't realize it was that much. That was that high.
Yeah. And if you look, the net longs have been relatively flat. So there, in my view, I asked the question, does that leave room for lots of short squeezing? There's a lot of short contracts that if this trend is forced to change, they're forced often many of that could be trend following and other types of things that are going to be literally forced to unwind positioning. But we're at a super interestingly oversold level. Now, these are the numbers as of the 21st. They were only published on Friday. So today, later on in a couple hours, comes the new report.
Right.
You're going to be dying to see. Actually, though, it won't have the data because it would have been as of Tuesday. So it was actually
that's right.
Positioning. It would have. So we'll have to wait another full week to see the impact on positioning.
By the way, if you want to learn about this caught trading, where do you go, Patrick?
Caughtsignal.com. Thanks, Kev. No, by the way, it is a completely free website. There's nothing to sign up for unless you want weekly updates. But go check out and see this data. Like this yen data is so clearly visible. Like the whole point we did here on building the site was to decode these COT reports to make this much more visibly thing without a bunch of spreadsheet numbers. You can literally see it on the charts and analyze it. And so it's really interesting to see that yen positioning, Kev.
And I agree with you, Patrick, that the yen unwind of this carry trade could potentially be another wrinkle that ultimately makes risk assets go offered.
And right? These are just a number of things that can go wrong. And that's, what we talk. What's interesting is that, by the way, did you want to comment anything in terms of further on the yen before we go through some of the others?
Nothing. I guess one of the things I will say in terms of the yen is another trade that you might want to think about is the CHF JPY, which is the Swiss franc Japanese yen. And the reason you want to use that is especially if you want to use that as a proxy for the stock market. And one of the reasons you might use that as a proxy for the stock market is that the Swiss are much more prone to having what's called a high hedge ratio. So when they own American assets, how much of that currency that you hedge actually is varies from country to country, and it depends on just the tradition and also the regulations. And the Swiss are known to be one of the countries with the higher hedge ratios. And if you have a higher hedge ratio, what that means, Patrick, is if imagine a Swiss pension fund that owns U.S. equities, as the U.S. equities have risen in price, you've had more U.S. dollars to sell to have your hedge ratio. So therefore, you sell U.S. dollars, buy Swiss franc. And so as the U.S. stock market has done so well, they've had more and more Swiss francs to buy. And you contrast that to the Japanese, who are prone to not having any hedge ratio. And they've just, especially through these Nizai accounts, which is their retail account, have just been buying U.S. equities. And so what they do is when they buy U.S. equities, they're buying U.S. dollars, selling Japanese yen. So if we get a situation where the stock market comes unglued, we could have the Japanese selling their stocks and repatriating the money back to Japan, which would cause the yen to go bid. And at the same time, as U.S. stocks go down, the Swiss have to reverse their hedging that they've done in terms of their hedge ratio, which would entail them selling Swiss francs, versus the U.S. dollar. So that ends up being a great proxy, CHF JPY.
And I'll tell you, that's a clear breakdown of a trade range.
Yeah.
Right. Like that's a next distribution cycle that lasted through a good chunk of the year and throughout the entire year. And this is a breakdown of the 1 year range.
Yeah, there you go. There we got a little technical voodoo magic on top of some fundamentals.
It just broke to a lower low. That's not voodoo magic, buddy. It's
okay. Right. What else we
got? Let's just punch a couple charts.
Okay, I'll let you do your magic from here on in.
Yeah. What I want to just highlight how weak the asset that shall not be named has been.
Okay.
You can see here.
For those who don't know, that's Bitcoin.
Yeah. And you can observe it barely it couldn't even touch its 38% retracement. And what were all of its previous trade ranges in the past act as overhead resistance. This, I think that Michael Saylor has a date with Leopold. And maybe he's going to show up at his wedding. And but you know what? This another break here in Bitcoin, it feels like the path of least resistance, and that's I think something you don't want to ignore here. The just let me just here. Obviously, we have to talk crude oil.
Okay.
Uh, what it was quite shocking, um, just uh, how deep the selling was when that peace deal, initial attempted peace deal, was announced.
Yeah.
Just the fact that oil, without dealing with any of the inventory problems, other stuff, dropped so substantially and significantly. Now we had off of that low a 40% rally. And again, 40% don't take you back to the highs in the same way as Kospi, but but it was a 40% rip, and we're starting to consolidate above the 50-day moving average in a period where the war uncertainty is still very high. Inventories are depleted. There's a lot of things that can happen in oil. But what was fascinating to me, I'm going to go back to the COT charts here for a second and look at these commitment of trader reports where they give these insights into positioning. I want to highlight that while this score shows at 22%, which is quite underowned on a 1-year look back, when you look at the net positioning as a percentage of open interest, we were only lower before the war started, even after this bounce. And what's particularly interesting, Kev, is when we break it down and look at gross short positioning in crude oil, right? We're at a 5-year low. There
Wow.
go again. We have not seen this many people short oil in the futures market on these contracts at any point in the last 5 years.
Well, Trump told you it's going lower.
And what's interesting about that is long positioning. So, and none of these shorts have been shaken out. None of these shorts have been shaken out. And we've already seen this data on the 21st. So a good chunk of the rally happened already. And longs, which were at near 390,000 contracts, Kev, back in end of May, basically were unwound like 20% of their position down to 300,000 contracts net. So longs were clearly being squeezed out, but they didn't start rebuilding their longs. So we have a situation where oil ripped 40%, reclaiming its 50-day moving average. Dips are being bought, and we have seen no short covering in oil, and the longs have not started rebuilding their longs.
Wow. It's a disaster. It's a disaster waiting to happen. And this is unfortunately one of the problems, Patrick, that you get when you try to manipulate markets. And one of the things is that when you beat it out of people so that there's nobody is short your stock or nobody is long oil, it means that, or when you have a situation when there actually is something bad that occurs, there's nobody to take the other side. And that's what really scares me. And it's a great way of you highlighting it is what happens if this gets worse? Instead of all of a sudden there being some people that are willing to sell at 120, there's nobody. And in fact, there's some shorts that need to get it back in. So now all of a sudden you've exposed us to this right tail risk that is much, much higher because you've been so busy trying to talk the oil price down.
Yeah. Right. And I'm sure there's no shortage of conspiracy theorists who think that that short interest is there quite intentionally by a player on the field that shall. But
the U.S. Treasury, you mean?
And something like that. I'm not claiming that, but there are going to be people that are going to speculate that, right?
We'll leave those people for the macro voices.
Yeah, there you go. So you're a wanker. All right, so let's move on to gold. Okay. This chart is deceptive because we had a contract roll that made this look more pronounced. I'm going to just go to September. Gold has actually, during this entire FOMC bond route and everything, actually flatlined. And I find that interesting because if you told me what's happening, real yields, the long end of the curve, the surprise buy thing. I mean, maybe the alleviation of the dollar rally acted as a little bit of a offset, but I was expecting a more volatility in gold. And
Well, and
gold
also for it to go down, right? Because those people who believe that higher
naturally
rates,
could have gone down,
yeah.
but just volatility in any direction. Just give me some, like, I would have thought that gold would have responded. And you know what's, again, I'm just going to pivot back to these commitment to trader charts. But what was super interesting when looking just at net positioning, again, we haven't on a 1 year look back, we're getting close to washed out in terms of positioning. But what's particularly interesting is all year, the number of short contracts and the number of long contracts by large specs has barely budged. It literally has been flatline. We've gone through a bubble peak and subsequently a 25+% correction in gold, and commitment to trader positioning on large specs is relatively unchanged.
Yeah. Well, Patrick, this is further proof to my theory that we aren't driving this bus. This bus is being driven by the People's Bank of China. And all you had to do is look at the result, the announcement that they made recently that they have brought in the most gold that they've like in terms of the most amount that they bought in a month ever. And I think that they've standing in here and then said, they've Gandalfed this and said, thou shall not pass, right? Like they put the stick down on the ground, and hopefully they don't end up falling into the chasm like Gandalf. But the reality is that is what's happening here. And I've said this before, and I'll continue to say it, that folks that are staring at the US dollar and real rates to try to trade gold are using the wrong metrics. That is, and that used to matter. That no longer matters. It's the People's Bank of China, and just stop worrying about real rates and worry what the People's Bank of China is doing. And to me, the kind of the flaring up of hostilities and the reality of, Trump going out and saying that they were responsible for trying to sabotage an election. You're sitting there and you're China. What are you going to do? Are you going to keep buying treasuries? No, you're going to start to buy more gold. So that's the longer term.
But anyway, gold isn't dead. There's no evidence of a new bull phase though, Kev. So, you can talk about that story, but I'd like to see some sort of price action in gold that actually shows that it's being accumulated. And
okay, but the first step is for it to stop going down, which is good. Yes. The sideways, right? Like that's the first step.
If I was to tell you what I think is going to happen, is we're going to get a spectacular turtle head, and it's going to be a turtle head that pops quite a bit. And when we get some market volatility in gold, in the broader market, I think there will be some sympathy pain, and we're going to see it's maybe one more leg down, but that will probably be the bottom. That will be the moment to buy. I think that if there was even a small flush out over a week or two that got gold down to 38 to 3,600, you buy that dip, because probably 4,000 is a realistic fair value zone, and therefore you're sort of you're taking advantage of, especially if it's broad, especially if the selling is accompanied by broad liquidity happening across the other asset classes. Right. Okay. Like if it's not just gold by itself, but if it's gold reacting to the intermarkets, then I'd buy it. Like, I think that would be an interesting phase. So I want to segue, unless you have something to add to that.
I just say that maybe the long end goes no bid, everything goes down. And then I still think that gold leads us out of the next whoosh in risk assets. But anyways, let's go on to the next.
So I want to just briefly show you one quick thing on the COT reports on treasury bonds, which I thought was super interesting to collaborate the thesis that we agreed upon.
Okay.
Notice large spec positioning on 2-year notes. It's at the 100th percentile. What is the large spec positioning on long bonds? Almost at the 0 percentile, right? Like, we basically have very clearly that shift. But what's interesting is when you look at net positioning on the 2-year note, notice that the majority of actually the buying was not longs rebuilding positions. Long positioning has been flat. It's actually been short covering. Notice
Right.
here that large specs are doing huge amounts of short covering into this selling. So there is an increasing consensus amongst large specs to basically unwind their short position in 2-year treasury notes. But no long positioning being built, which basically tells me that I don't want to call it a crowded trade. Even though this is crowded, it's not crowded from longs rushing in. It's actually the rating got crowded because shorts are covering. And so therefore I would not be fading this crowded rating. I actually think that the 2-year has room to go because of the way I interpret that. But just quickly, and then I'll let you comment. But it's a little different on the 30-year because the 30-year, the longs have been relatively flat, but the short position in the long bond continues to build. And so far, that crowd has been rewarded. There's been positioning by the large specs that the long bond's going lower, and it has been. And so the crowded trade is not being squeezed yet, but it is getting crowded. There is a consensus view showing out there, and short positioning in that treasury by large specs is building. And so that's interesting because it really does kind of collaborate. I think there's no contradiction to what we've been saying when I look at that.
Sounds good. One of the things I worry though about with those COT reports is that you need to be aware that the basis trade is in there, and sometimes the trades that are labeled as speculative are actually hedged, and it's a little more complicated. But
it makes it more deceptive, but it is still an interesting story.
Right.
Very briefly, just two things. Number one, copper remains large spec positioning quite crowded. Long positionings are there. A little bit of an unwind during the 1 month correction, but generally the long copper traders have been rewarded. It's still a very generally bullish chart.
Yeah.
And out of the commodity markets where majority of the things have gotten their ass handed to them, copper is remaining at 52-week highs, actually all-time highs, and it actually looks like it may go.
It's looking terrific, isn't it? It really is a good looking chart.
If this thing breaks 52-week highs, we could see 7.25. And so let's see whether or not copper can confirm the generally strong bullish positioning with that breakout. The other thing I wanted to just touch on is just how legitimately dead the uranium market has become. And like this is like if it was a patient at a hospital with a pulse monitor, the doctors would be sure it's dead. Like look at it, it's like flatlined. The uranium market has just gone completely silent on the physical uranium. Obviously, uranium stocks have been going through a challenging little thing. We just had Cameco's earnings come out. And the earnings came in a surprise loss. The stock actually gapped higher and gave it back. Point here, uranium remains in a distribution cycle, and so far the sign that that Cameco turning it around for the space is not evident. And so at this moment, I think uranium and gold, no matter how much there's a group of resource investors that love this space.
Yeah.
And at some point, there's going to be big money made in that space all over again. There is zero sign at this moment that either of these two markets have woken up. And you have to respect that they're in some form of a bear / distribution cycle. And there is zero evidence that a new bull cycle has begun in that space. And that's all I've got, Kev.
That's awesome. All right. Let's call it a day. Patrick, where can they find out more about you and your wonderful charts and team?
Listen, if you want direct trades from me, you go to bigpicturetrading.com and my analysis. But, we created this cotsignal.com page, completely free, no strings attached, no paywall or any hidden thing. Literally just free resource for everyone to use. You'll find snapshots of it in the Macro Tourist newsletter, I'm sure, at some point once Kevin starts using it. But no, you looked at it. But the point is that it's a completely free resource, and a lot of the stuff we talked about, you can see. Go check it out and see what's going on there.
All right.
Kev, where can they find you?
Oh, they can go to macrotourist.com. Listen, bear market, bull market, was happy for you guys to spend some time with us on this crazy ride. Now stick around for the after show. Here comes Danny. Right. Although, you know what, Danny? I was just kind of trying to figure out what a better name for you would be. And I've decided Oliver would be a name. I was looking for the most popular names in Australia. And it seems to be they're all named Oliver. I don't know, but for those who are listening and not watching, Danny's got the mustache and the mullet going, and very much looks like an Australian.
Yes, there's been many comments.
Have they Yeah, saying that you're gone full.
No one
Australian.
believes your English.
No,
you gotta shave the sides though.
Yeah, I was going to say it's not a mullet. It's like I've just gone very long with the old barnet, but
yeah,
it's not full Straya yet. So.
Yeah, it's full Straya. Okay, we got to do your beer, Patrick.
Listen, shockingly, I have not drank this. Danny's claiming that he's drinking it all the time. This is my first time trying it, so this was actually a legitimately interesting thing. And what I find fascinating for literally one of the few U.S. beers that make it to Lisbon, because in Portugal, generally it's a lot of these microbreweries around here, but it's very hard to find U.S. Kind of beers like this here. There's no such thing as a Budweiser being sold in Lisbon, so the fact that I found it was cool, but I loved it. Danny, it's a solid pale ale, and Kev, you're a fan of pale ales, right?
I do like the pale ale, not the IPA, and the pale ale. So what are we giving it, Patrick?
I'm gonna give it a 8.3.
Ooh, that's high for Patrick.
No, this is. I say that it's sessionable.
Oh God! Do they even sell this in the U.S.? What's the name of it again?
Sierra Nevada.
Yeah, like the mountain range in Spain. Sierra Nevada.
Oh, there it is. Brewing. I don't even know. I've never seen it when I've gone somewhere in the States. There's 3 monkeys are their logo. Very apropos. It's like us. The 3 monkeys.
Yeah.
There we go. Oh, they got bison on the front. You got to love that. I'm a big bison fan. For those who don't know, I am a big bison guy. For those who don't know, that's a buffalo. Okay, well, I'm gonna have to try one, guys.
You know what? It's 100% worth trying. It's a good beer.
So, Danny, are you still out in your camper van?
Camping life. That's it.
Camping life.
Always on the road.
Yeah, and Patrick, how was your?
It was awesome. I had an absolute blast. I ended up parking my ass in Costa Brava, Spain, which is outside of Barcelona, just on the French border. It's the Spanish part of it very much is like the French Riviera, but in Spain, right? So it's got that entire French Riviera vibe to it. And so chill, so good. Shockingly, not a big touristy area, only for kind of like the local Europeans that know about the area.
Well,
but it's got absolutely.
There's going to be North Americans coming now.
Yeah, because I've got that much pull. I can do it.
So you've camped in Canada. What contrast them?
Oh, it's completely different. I was on a beach, on the ocean. In the end, in Canada, you're on a lake being eaten by mosquitoes. There's not a single bug out there in Spain, right?
So what you're saying is you miss Canada?
In Canada, there's really just the four seasons are fall, winter, spring, and bug season. It's
it is pretty bad. Like May and June are bad, but July is not so bad in Canada. Like,
there you go.
August is nice. August is nice. The bugs go away. And for those who don't know, the bugs are bad. Like, you can't really appreciate them until you're out there. I went hiking with my wife and we forgot bug spray, and I thought I was gonna lose my mind. I got chewed up something fierce. Like, if you forget your bug spray, you're in trouble.
Oh yeah.
Yeah.
Absolutely.
So, and what beach? Oh, sorry, Patrick. Go ahead.
No, I was saying that one of our Huddle listeners, Frederick, pinned me out or picked me out in the crowd out there in Costa Brava, and he
did,
he approached me, so I just wanted to do a shout out to him. It was a pleasure meeting you, buddy.
That's funny, getting recognized out in the road.
Yeah,
and Danny, what beach are you on, buddy?
A Portuguese beach.
You don't want to say? You're too worried about the. Oh, you don't even know the name of it.
Yeah, it's more. Nobody's gonna come and find me. Like nobody gives two.
That's not
two
true.
tosses about my beer recommendations, but I just don't know
the seven women who would listen to our show are gonna come find you. Yeah.
Exactly.
Everyone, have a great couple of weeks. We'll see you all. Take care. Thanks for tuning in.
Cheers, everyone.